Gaining knowledge is the first step towards wisdom, and sharing knowledge is the first step towards humanity. Good evening, everyone. Myself, CA Shivpriya Kaur. It gives me great pleasure indeed to welcome you all in today's session on Global Trends in Internal Audit, a look ahead. Internal audit function recognized as one of the checks and balances pillars for sound corporate governance and business prosperity. We are living in an era of digital revolution where automation, artificial intelligence, big data are now a norm with significant impact. But digital technology can never replace a human factor. For organizations rarely fail because system fails, but often because human values fail. A robust and objective internal audit function is essential to match increasingly complex and technology advancing world. Today, we have with us eminent scholars of the industry and learned speakers to share their vast knowledge and experience on this topic. I express my profound and heartfelt gratitude in welcoming respected CA Charanjot Singh Nanda Sir, Central Council Member ICAI and Chairman Internal Audit Standard Board, CA Gyan Chandra Mishra Sir, Central Council Member ICAI and Vice Chairman Internal Audit Standard Board, CA Dilip Kumar Singh Sir, Chairman Gautam Budh Nagar ICAI CIRC branch, along with industry expert speakers for today's session, CA Yukti Arora ma'am, CA T. Sankara sir, and CA Sudeep Modi sir. We feel very fortunate to be a part of this enriching knowledge transfer session, having been contributed by each one of you. I now take this opportunity to welcome CA Dilip Kumar sir, Chairman Gautam Budh Nagar branch of CIRC ICAI, and thank him for his valuable presence. I extend a warm invitation to him to address our participants with his opening remarks. Sir.
Thank you, Supriya. Very warm good evening to everyone. I, Dilip Kumar Singh, Chairman of Gautam Budh Nagar branch of CIRC of ICI, welcome you all present here on the today's virtual CPE meeting on Global Trends in Internal Audit, a look ahead. Organizing by Internal Audit Standard Board of ICI and hosted by Gautam Budh Nagar branch of CIRC of ICI. I thanks to Charanjot Singh Nanda sir, Central Council Member of ICI and Chairman of Internal Audit Standard Board of ICI. I also thanks to CA Gyan Chandra Mishra sir, Central Council Member of ICI and Vice Chairman of Internal Audit Standard Board of ICI for giving an opportunity to host this virtual CPE meeting. I also welcome and thanks to our technical experts and today's guest speaker, CA Yukti Arora ma'am, CA T. Sankar sir, and CA Sudeep Modi sir. If we talk about today internal audit session, so internal audit is a properly structured internal audit function, impacts and not just regulatory compliance, but also operational excellence. Today, the role of an internal auditor has evolved from merely financial reporting on control to managing risk, prioritizing goals and activities, eliminating complexity and redundancy. In this seminar, we aim to signify how internal audit is now under greater scrutiny to be able to efficiently identify key risks and guide organization so as to brace ourselves against uncertain situation in order to be at an advantageous position. I hope this virtual CPE meeting turns out to be productive and inclusive session for everyone. Once again, I heartily thank you all for attending this virtual CPE meeting. Thank you, and over to moderator CA Supriya Kaur. Thank you, ma'am.
Thank you, sir, for your valuable insights. Thank you so much. Ladies and gentlemen, we have with us CA Gyanchan Mishra Sir, CMA, CPE, Central Council Member ICAI, and Vice Chairman Internal Audit Standard Board. He is also a member in approximately 23 committees. My heartfelt welcome to you, sir. Our participants are eager to hear a few words of wisdom from you. Sir.
So thank you, moderator of the session, Supriya Madam, and of course, very distinguished and learned Chairman of the Internal Audit Standard Board, my elder brother, Charanjot Singh Nandaji, very learned and distinguished speaker, Yukti Madam, and her co-speakers, officers of the ICI, and respected participants of today's program. Good evening to all of you. Friends, internal audit has become backbone for the managerial function as of now, and internal audit blend with technology, cyber systems, that really is very encouraging as of now, because we are totally dependent on the technological upliftment in the audit system at this juncture. My feeling is that we have to come forward to understand more and more about the technology and skill development for the purpose of giving more to the profession and society at large. Technology has become such an integral part that even if we want to do something without having any technological equipment, technological knowledge, so we will find that very difficult in this technological era. So this session is really very important for all the participants, because this is the blend of the technology, how you have to go towards the internal control system, internal audit, and of course to the managerial related output-based systems as of now. Friends, I am traveling for 2 days. I am really sorry that I could not make it possible in the previous session also to interact with the members. But I am really very happy to see that the board is working day and night for the members, and such topics which are really encouraging to enhance the skill sets of the member is going to benefit them at large. The time has come that we as a accounting professional have to have the international and global level knowledge base regarding the skill sets to use while auditing the various corporate houses. Friends, we are not only providing the services to the management. By this way, we are certainly going to enhance the financial statements values, and by doing that, we are going to get benefited the country at large and of course the globe at large. So thank you, madam, for giving this opportunity to interact with the member. And once again, I am thankful to the board, and I am thankful to Nanda sir that he always is so committed for the profession, that he is with new ideas, out-of-box ideas for the members. Thank you once again.
Thank you, sir, for your vision, your extraordinary ability and leadership to guide us at all times. Thank you, sir. It is said that human potential is not of any kind of measurable limit. It can go as far as you have the courage to walk. My next leader needs no introduction, as this institute owes a lot towards his persistent efforts for years together and selfless contribution towards growth and proficiency of this institution. An ardent orator, a devoted professional, an epitome of academic excellence, C.A. Charanjot Singh Nanda sir, presently Central Council Member ICAI, Chairman Internal Audit Standard Board, Vice Chairman of Banking Financial Insurance Committee. He has held various high positions to his credit. Chairman, Professional Development Committee, Chairman, Cooperatives NPO Sector, Chairman, Committee on Banking Insurance, Vice Chairman of Research Committee, Chairman of Committee on Financial Markets, Investor Protection, member of SEBI Advisory Committee, member of South Asian Federation Accountants Committee, convener of expert group constituted by Ministry of Corporate Affairs. He was also the chairman of Women Members Empowerment Committee and vice chairman of Committee on Public Finance and Government Accounting. He was also the member of Quality Review Board set up by Government of India and various other dignified positions all through his professional journey. I feel extremely delighted to welcome C. Charanjot Singh Nanda sir and request him for the welcome address and keynote session for our participants. Sir.
Thank you, Shripriya, for a very scintillating session of moderation. My very dear younger brother and Honorable Co-Chairman of the Board, C.A. Gyan Mishra, C.A. Dilip Kumar Singh, Chairman of Gautam Buddha Nagar, the very reverend speakers, Madam Yukti Arora, Mr. Sankar, the board officials, Arun Agarwal, and all participants have come here to go home more enlightened. Ladies and gentlemen, we are back yet with another exciting, happening session on internal audit. Let me very candidly accept that we at Internal Audit Standard Board are very keen to ensure that you get best of the services at your doorsteps. We are very keen to host best of the speakers, not only in the country, but in the globe, to ensure that you have the requisite skill sets to go and serve your clients and the nation at large. So I have my keynote address. Wait for a second. I just put on with my keynote address. Give me a second, please. Shripriya, is my screen visible?
Yes, sir, it's visible.
Great. So, ladies and gentlemen, today's topic, the larger topic is global trends on internal audit, a look ahead. And the coverage of today's session will be three. The first is of cyber security, risk assessment and auditing, a very, very pertinent topic, which is contemporary to today's times. The second, role of internal audit and risk management with special emphasis on strategic risk management. And third is enterprise risk management. So when you come on to the cyber security risk assessment and auditing, you understand very important four areas. Cyber risk, one, where does it evolve? How does cyber risk come? When the data grows, yes, data grows and it keeps on adding value. And in today's time, if there is some gold, there is some oil, it is only data. Data will ensure that proper decisions are taken by the audit committee or by the board as the case may be. Expansion of technology. You'll use technology to lower your tensions. You'll use technology to lower the human interface, lower the incidence of error. And with that, you'll become exposed to so many technological expansions and which again are a doorstep to cyber risk. Third, evolving business models. Yes, you want to get across and work in an environment where you can perform at the highest level. So you evolve your business models and anything which is new needs testing, and whenever testing is done, it leads to cyber crime. And then you have a very motivated crowd of attackers. Yes, cyber attackers who understand that in today's time, they are at a right stance because people, when they grow a bit careless, it is the cyber risk, the cyber attackers who go ahead and take hold of the entire system. So, ladies and gentlemen, cyber risk is something that is now terrorizing the entire industry, and therefore, cyber risk needs to be countered. I am reminded of a risk. A gentleman gave a call to me and said, Mr. Nanda, please tell me a business where there is no risk. I said, I'm a chartered accountant of 31 years experience. And till date, I have not found any business which is without risk. And let me tell you, my friend, that where there is no risk, there is no opportunity. So look for calculated risks. Look for risks that can be mitigated so that you are able to work in that function. Now, what is the role of internal auditors to counter cyber security attack? They have to be vigilant. They have to have the idea of how they can find out the cyber attacks. They have to be very much updated because I had the chance to go to the National Forensic University at Gandhinagar, which is very near to Ahmedabad. So there I could see a big dashboard where all cyber attacks were being noticed all across the world. And there were certain cyber attacks which were totally new. They were born and they were experimented. So the role of internal auditor is to ensure that risk is mitigated, cyber risk is mitigated, and in case any new cyber risk crops in, it is immediately tackled. The second session is role of internal audit and risk management with special emphasis on strategic risk management. Let me tell you that organizations are facing a wide range of risks. What are the risks? Strategy risk, culture, ethics, IT and data security, etc. In addition to the traditional focus on financial risk and controls. Say 10 years from before today, the risks were largely financial risks and controls. But today, the risks are diverse as the culture. It is a risk of strategy. Whatever strategy you make, there's a counter strategy, disruptive technologies, you are aware of it. Cultures, ethics, IT and data security is one of the greatest risk mitigated area where you need to work. Now, what is the value of risk management? Risk management essentially is a central part of any organization's risk, any organization's strategic management. If you are not able to mitigate risk, you are on a head of, you can call some explosive which can always throw you out, which can always derail you. Now, one very important thing which I would like to share with you is that successful organizations seek to integrate risk management and internal control into all activities through a framework of risk identification, risk assessment, and risk response. Three important areas which you always need to remember. Risk identify the risk, assess the risk, and risk response and mitigation, so that when risk management and internal control both are mitigated, you are able to effectively service your client with a better impetus. The last thing which I would like to say in this version is internal audit is uniquely positioned with an organization to provide assurance to the board and senior management to the effectiveness of risk management process. Yes, internal audit essentially is a management function and it has to report either to the board or to the audit committee as the case may be. So, internal audit has to be uniquely positioned to provide assurance to the board and senior management so that they are able to effectively understand the risk management processes. So, ladies and gentlemen, coming out to the third session, which is enterprise risk management. You are aware that what is the role of enterprise risk management in business? The first, it enhances enterprises' resilience to tough times. That is very important. Not only we, the institute, but the entire organization needs to be resilient because anything can happen, they have to be forward-looking. It increases positive outcomes and advantages while reducing negative surprises. Yes, enterprise risk management ensures that whatever you get is positive rather than getting a bad news, which is ultimately moving on to plunder your business. It reduces performance variability. Variations are the biggest bolt to any profession. So any company. So you have to very well understand that any business enterprise, when it comes to variation, it is not able to effectively draw a plan for success. It increases the range of opportunities which are there with the entire enterprise so that it is able to effectively use its strategies, its thought processes, and guidance from the board to create value and stakeholder wealth. Improving resource deployment, very, very important. What type of resources are required and how they have to be retained is very important. Now I come to the last leg of my presentation, which is integration of ERM with internal audit practice opportunities. Please understand, first thing is core internal audit roles needs to be merged with regard to ERM. What are the core internal audit roles? Number one, risk-based internal audit plans. Very, very important. The internal audit needs to provide assurance that risks are correctly stated and evaluated. The evaluation of risk is very important. Third is provide assurance that mitigating actions are operating. If a risk comes from nowhere, it can immediately be conquered and mitigated. Evaluate risk management process, and every time when you find that there is something which is more difficult, which is overweight, then it has to be immediately tackled. Evaluate reporting and management of key risks. Very important. You can't be risk-free, but you can be risk mitigated, you can be risk-averse, and you can always find out risks which will help you. Now, what are the additional ERM roles an internal auditor can perform? These are the extended roles other than audit. First, facilitate identification and evaluation of risks. You have to identify risks, and the most important internal control issue is to plug the loopholes wherever they exist. And for that, you need coach management, because coach management will ensure that risk response is facilitated. Coordinate all ERM activities. Any enterprise risk management activity needs to be on the table and under your scanner. Consolidate risk reporting, which is very important. The risk which is reported has to be consolidated and every facet needs to be properly assigned and defined. Maintain and develop ERM framework. Very, very important. The enterprise risk management framework has to be maintained and developed at a larger canvas so that you're able to effectively utilize it for achieving the goals as decided by the board. Champion establishment of ERM. Very, very important. ERM, which can always show you the designs on which the work has to be undertaken. Develop ERM strategy for board approval. Yes, the board needs to know the risk which it is taking and what are the means to mitigate that, and that should be under the board's approval. The strategy needs to be known to the board. And third and the last area which I want to tell you was ERM roles and internal audit should not take. This is the work which management has to do and internal auditor cannot take. The first, set the risk appetite. The appetite is always the working of the person who is consuming. So when the management is there, it has to eat the risk. It has to know the risk appetite. Deploy risk management process. You can't do it. You can suggest, but deployment has to be done by the management. Manage risk. You can mitigate risk. Tell ways and means, but the management has to be undertaken by the management. Make decisions and implement risk responses. Not at all appropriate. That has to be done by the management because the management or the board has to decide what has to be the effective mitigation and importantly, effective risk appetite, the calculated risk that they want to take. Implement mitigating actions for risk management. Again, very important. And last is accountable for risk management. An auditor is never accountable. It is a management because it knows the risk appetite. It knows the calculation which it has to take. So, ladies and gentlemen, I'm done with my presentation. I want to thank you all for giving me patient hearing. And more importantly, I want to tell you all, and just give me a second. Yes. So I want to tell you that this session is going to be a very, very exciting session where you can carry home so many things. Your strengths will be boosted and more importantly, all your doubts will be addressed. Over to Madam Shivpriya for her further proceedings.
Thank you, sir, for your valuable insights and letting us know key critical areas of today's topic in discussion. We aspire to follow your footsteps and shape our professional growth. I'm sure the next few hours from now of the session will be the most productive and memorable one for all our participants. Before starting the session, I would like to mention that our participants are free to post subject-related questions in the link, and our speakers will be elated to answer them at the end of the session. With this, I take the opportunity to welcome our first speaker, CA Yukti Arora ma'am, CA, CISA and DISA, presently Process Risk and Technology Practice Leader at Omnia Consulting Services and previously worked as Director of Big Four. She has more than 2 decades of experience in the field of process and risk advisory and has extensively worked in manufacturing, consumer, automobile, e-commerce industry. She is also a regular faculty with Digital Accounting and Assurance Board and Internal Audit Standard Board. I welcome you, CA Yukti Arora ma'am, to please take forward the session for your topic. Thank you.
Thank you, Shivpriya, for introduction. Thank you, Nanda sir, and all the esteemed members from the IIA and ICI. Also, thank you, Mr. Dilip, for giving me this opportunity. Thank you, everyone from Internal Audit Standard Boards and all the esteemed members of CNC2. So today's topic, which I am going to cover, is on cyber security risk assessment and audit. And this is one of the most important risk, as Nandaji has also mentioned, that with technology being everywhere and digitalization being there and the data being generated at such a fast pace, there is a risk of people who are trying to exploit this and generate some cyber attacks and do generate some income out of it, because now data is new gold and therefore the risk has increased a lot in this field. The agenda which I am going to cover in this 45 minutes is why we need to have this audit, the approach for risk assessment, then some illustrative risk and controls, and how we can report on this cyber audits which we perform. So if you look at it in the current world, everything is connected to everything. Whichever business process you pick up, most of the business activities are currently digitalized. Whether it is a sales system wherein you receive the order in a digital manner, and then you generate the lead also through a social media and then record it in the ERP system, and even the delivery as well as after sales services all are done through a digital mode. The entire logistic management, warehouse management, inventory is being done from the systems. Even the delivery challans are being generated from the systems. The HR, the records right from the selection of the profile from the LinkedIn, identification of them, and then selection, and then the recruitment, the entire life cycle is currently in a digital mode. Similarly, if we see at the purchasing cycle, right from the point we identify the vendor to the time we actually procure and get the material in, entire cycle is through the system itself. All our reporting, books, taxation, filings is being done digitally. When everything is being done digitally, everything is being done through the system, definitely there is a risk which is arising, which is a technology risk, a digital risk. Because when we are doing, and as Nandaji was also mentioning, when we move from exploit an opportunity, there is a risk which also arises. So the risk of cyber arises because of the same. And it is a very, very real risk, because whenever we connect over internet, there is a potential of some threat which can come because of the cyber attack. Because in the current world, there are interconnected ecosystems. We use a lot of third-party systems, the vendor systems, wherein they are cloud service providers on whose we are installing our applications, we are storing our data, and also who are required for the purpose of our transactions also. So when we utilize these services, when we connect through APIs, when we connect to these ecosystems, it brings a new threat and which requires a consideration. Our plants, which are going more and more automated, implementing sensor technologies, implementing various workflows which are digitalized, and we are moving to industry 4.0. So when we adopt those types of technology, a new risk of connectivity, new risk of cyber threats because of those connectivity arises as a result of the same. And not everything is integrated. So wherever we connect at that point of time, the access to the third party is given or to the fourth party is given. It brings a new thing, because even if the organization would have done some good risk assessment planning, it may be that the third party or fourth party may not have that similar type of controls and processes in place. When we connect to our customer digitally, provide digital customer support, again, there is a huge exchange of data which happens, and many a times it is through chatbots, and chatbots are always a system which are connecting to our internal system, and when these systems are exposed to the internet-facing thing, the risk of their being compromised rises. Innovation can be seriously impaired if we do not look at the cyber risk, because if one cyber incident can actually make the company more conservative and actually stop the entire process of going digital and innovating in this phase. So one has to always look at the risk while we are innovating. the current work from home, which came from pandemic and which is now continuing as a new normal. We have a lot of connected devices from our home. We are connecting through virtual private networks, and these virtual private networks are exposed to the corporate ERP system. So they also bring the new risks which are there as a result of these cyber attacks. So all these things, wherever we connect, wherever we go, we are exposing ourselves to a new risk, which is a connection risk, and which is because we are connected to internet. There are threats which comes because of it. And currently, if you look at it in the current environment, yes, the risk of cyber impact is really high. But like various surveys have shown, the data from the CERT-IN has shown, the various information which has been published by agencies, the regulators, they show that the cyber attack has increased, in fact, from 2018 to 2022 to 4 times. Even the attacks which were in 2021 were 11.5 million in India, and they, in the first quarter itself, which is 2022 first quarter, they have gone up by 2.21 lakhs. So that shows the pace in which it is rising and it is increasing, and the amount of loss which has happened is more than 6 billion over the last few years. So that is the impact, that is the level of thing, and that is the likelihood. So not only the impact is high, the likelihood is also high, considering the fact that we have seen these types of things happening, and even like individuals have been subject to cyber attack. The corporates, large and small, all have been subject to cyber attack. It is something like somebody comes to know about it and somebody is unaware because they do not monitor. But this type of attack every organization has faced in the last few years. If you look at the breaches which has happened in 2022 first quarter itself, we will see all like you'll see the name of the large organizations which have been exposed to this, and each one of them have a very, very robust cyber management mechanism, and they have extremely good ways, tools, sophisticated systems and teams to manage the entire cyber risk, but still they have been exposed. And the reason why they have been exposed is because of the sophistication of the attack, because of the target attacks which are being made at the current level, because of the potential of codes being stolen and being utilized and as a new income source, or because of the potential of data being utilized to penetrate further attacks. See, in the case of Samsung, the source code itself was stolen. When the source code is stolen, then those vulnerabilities can be analyzed, and then those vulnerabilities can be also further exploited, and a larger attack can be planned based on it. So every organization, large or small, is being exposed to this thing, and therefore audit committees, the board of directors, and every organization needs to take this very seriously, and definitely in their plan have a cyber risk assessment, and also based on the risk assessment have an internal audit plan for the cyber element. If you look at the data from the World Economic Forum for the top risk by likelihood and impact, you will see cybersecurity failure both coming in the likelihood as well as IT infrastructure breakdown coming by way of impact. So therefore, it is high on the likelihood and high on the impact also. Now, how do the company take it forward? How do the company perform the risk assessment and identify which areas of technology they need to cover as a part of this cyber thing? Because organizations have many systems nowadays. It is not only one ERP which is there, but there are many connected systems which organizations in the current world have. There is a huge infrastructure which could be on premises or it could be on a cloud. There are various connected APIs which are there. There are various third-party softwares which the organizations are using, and some of the things are being software as services where they are utilizing softwares, or they could be infrastructure which they could be utilizing of some third-party vendor. So there are multitudes of assets which the organizations are having. So for any risk assessment from a cyber security perspective, it is extremely important that first of all, the organization needs to have an asset inventory, and the internal auditor needs to understand what all IT systems and IT technologies, applications that are being used. And the starting point of any of the risk assessment is to understand and see what systems, what things are there. So first of all, we need to understand that and gather the asset inventory. But it has been seen from various audits which have been going since last many years that this itself is a challenge in the current world. Why? Because many of the applications are installed by the end users themselves. They are integrating without even knowing the IT aware of those types of things. So what happens is there are applications which are being used as a silo application. There are many infrastructure items which were installed, but then they were not taken out. So that is still existing in the organization. There are softwares which are purchased and access was taken and then it was installed but they were not decommissioned. And that may not be appearing in the current asset inventory. So gathering this asset inventory, the softwares, the hardware, and the assets of data, which is the most difficult part to be done, because the company is processing and gathering a lot of information and data. Every department, every function is gathering data from various sources. So all that is a part of an IT asset itself. So knowing that entire inventory is a big challenge, and therefore the first step of an audit assessment, which is the asset inventory assessment, itself needs to be considered as a part of the audit scope. Once we have had the asset inventory, the next step the organization should consider is to look at the threats and vulnerabilities which are there. For doing this, what they can do is that they can see where all in past there has been a device misconfigurations, where all there has been where the system did not work or there were failures and the connectivity failed. The system was unavailable for maybe 30 minutes, 40 minutes, or the places where there was, because of misconfiguration, some wrong person was given access, or because of misconfiguration, the system did not work as intended. So all these repeat vulnerabilities needs to be identified for risk assessment. Then the assessment should be done of the threats of delayed patching, where the patchings have not been done in a proper way. And based on that patching history and the patching details, that could be considered as an area for this asset to be considered for the purpose of cyber risk assessment. Then the third area which the organization should consider is where there are known vulnerabilities. there are various known vulnerabilities which keeps on getting published, specifically when by the large organization, wherever they have been exposed to any incident or threats or something, they publish those types of vulnerabilities. Even if we use cloud services, these cloud services provider like AWS, Azure, Google, they keep on publishing the known vulnerability, and we are supposed to look at it and close those like things. So that could be an area which should be considered for the purpose of audit. Then prior incident. These incidents which have happened, it could be a phishing incident, it could be a DDoS incident, it could be denial of system incident, whatever incidents which have happened, that could form a basis for threats and vulnerability risk assessment. Then we need to also consider the systems which are installed for regular monitoring of infrastructure, like security incident event management, the security operations center, the network operations center, just to analyze the traffic and see from where the traffic is coming, and if network traffic is coming from an area which is from a place where we do not operate, then in that case, that could be an input for the purpose of doing an assessment and taking that into consideration. Then cyber incidents which are impacting the industry, the technology, and various cloud providers, those could form a basis. For instance, if we have got a report that the whole technology industry is being, the cyber attacks are happening, then definitely that area or where business area where we are doing technology business, that should be considered for the purpose of cyber audit. If we see that if there is a AWS or Azure or any of these cloud service provider which are being targeted, then in that case, or have been targeted, then we need to look at that of this IT system where we are hosting on those infrastructure and take that as a part of our audit scope. Then wherever we are engaging with the third party or fourth party or utilizing the system, that it brings inherent vulnerabilities and threats, so that needs to be considered for the purpose of taking into the audit scope for the cyber audit. Then reports which are coming from various tools which the organization invests on, like data leakage prevention tools, the threat intelligence tool, the vulnerability assessment penetration tests which have been happening. So from these all form an input for the purpose of doing an asset risk identification of key areas of audit, and then based on those identification, those specific data, those specific system, those specific technology should be considered for the purpose of audit, and we need to look at the entire process, the entire life cycle for the purpose of our audit mechanism, like right from the time when they are installed till the time they are actually decommissioned. Right from the time their governance mechanism is fixed, they are managed, monitored, and then how they are resilient. So all these aspects needs to be considered while doing this. Now we'll come to we know that cyber risk is one of the key risks. We know that cyber risk assessment needs to be performed to understand that which area is the area which needs to be focused on, because in a risk-based audit, it doesn't make sense to test everything because it will not give the same success as it would be with a high impact. If it is a risk-based, if we focus on where the key risk is and audit that area, it will give the much better reaching consequences in terms of risk management. So from that perspective, identification of the key areas, and based on that doing the control assessment and risk assessment, and based on that doing the testing makes more sense. to do the testing, to do this, we need to also understand what framework the organization has adopted. There are various frameworks on cyber risk which are currently there. This being the most prominent one. Then there is a COVID, ISO 27001, then COSO framework, NERC, and then HITRUST. All these, they are frameworks which guides us how the organization design and implement and have cyber security in the organization. But NIST being the most prominent and most widely accepted framework as far as cyber risk is concerned, companies should leverage this framework, and the organization's auditor should leverage to understand based on this framework and may perform the audit based on the same. So the first step in the NIST framework as per it is to identify the crown jewels, the assets, and then to take an action on it, to protect it, to make sure that they are not exposed, and they are various cyber risk mechanisms identified, and then the corrective preventive actions are taken to protect those things by identity and access management mechanism, through encryption, through data leakage prevention, through proper code review, incident management. Like this, correct actions are taken to protect. And then once we have shown that we have protected, then also keep on monitoring it to detect if something goes wrong. And once we have, we are regularly doing a review and understanding, keep on improving and responding to if we find something wrong has happened, and quickly recovering and being resilient. So this framework talks about identification, protection, detection, responding, and recovery. And every element of technology should be looked from this perspective. So for instance, if we are looking at ERP, then the risks which are like ERP is identified, what risks are there with respect to access, with respect to changes, with respect to management of infrastructure, with respect to encryption, all those are identified. And then those controls are put, like access management control, change management control, encryption controls, so as to protect from a cyber attack. And then regularly monitoring the logs, the various reports which are coming from the systems, and taking an action on it and improving on it and recovering in case something goes wrong. So that's the foundation. The organization framework needs to be understood by the auditor, and based on that only they can plan and perform their audit. When the auditor starts the audit, they need to be very much aware of the key cyber threats which are there in the current world. So they are getting more and more sophisticated, and it's in fact like getting it's not only one attack. The current cyber criminals or hackers, they are using combinations of attacks. So they are combining phishing with malware. They're combining phishing with web attacks and DOS. They are combining 3-4 mechanisms to penetrate, because as the tools are getting sophisticated, people are getting more aware. They are also getting more intelligence while performing these types of attacks. Typically, we have seen increase in ransomware multitude. Also, we have seen phishing attacks rising to a great extent. And what is phishing attack? Somebody tries to get into, send a fake mail, or send a mail, or try to get into your emails and get the information. And when they get this information, they try to use that information for the purpose of going into the system, getting into the system by knowing your user ID, and then trying various types of passwords and getting into the application or to the infrastructure or to the database or to the network device. And once they get in, Then they try to attack and put a code or a malware and do those types of detailed investigations of flow of data and information and gather as much information as it is available. Once that is done, then they get into more sophistication, use another web attack and DOS attack, or and also get into this data theft. And at one point of time, when they have got a good hold of the applications or the system, then they suddenly bring it down to a denial of system type of attack or a ransomware. So combinations are being used, and various types of threats are coming in the current environment. They are coming from social engineering, they are coming from insider. It has been, various researchers have shown that around 80% of the attacks are done by using some or other insider who is within the organization. It could be employee, it could be vendor, it could be customer, it could be connected system. And through that, these types of attacks are happening. Now, so and all these like attacks which happen, typically at the end of it, it results not only in the reputation loss or data loss, but it also has a regulatory impact in the current environment. And companies have to bear a huge amount of loss in building the confidence back, because the once like these types of things happen, it becomes specifically if it is a technology service provider or if it is a service provider, these types of incidents make the organizations extremely vulnerable, and recovery from it becomes more and more difficult. So internal auditor should be aware of these types of things, and they should try to review the threats, the types of threats, and based on the threats, identify what controls could prevent those threats from happening. So they should assess the cyber risk framework which the company has adopted. They should assess the mechanism of asset inventorization, the assess risk ranking, the prioritization and identification of a crown jewel, and then the protection which has been given on those types of assets. Also, the organization's auditor needs to then look at who are the third party or fourth parties whose applications, whose cloud services the organization is using, and look at that whether they have been evaluated based on the third party risk framework. Their selection and their evaluation has included the cyber risk assessment as well. Whether they also have a similar control mechanism of cyber prevention and detection as the organization is having, and whether they have also put controls to prevent and detect the cyber risk. Internal auditors should also understand the APIs and various connected devices and look at them and see how security is being managed through them, how they are configured, what types of monitoring is happening on them. Then they should also look at what type of hardening the systems have gone through when they were installed, what type of baseline securities of making sure that default IDs were changed, the password parameters were adequately set, the audit log was enabled, the monitoring was there, the encryption was implemented, and so on and so forth. Those types of configuration checking should be done by the internal auditor. Internal auditor should also understand the risk of regular monitoring. If that is not done, then it may result in system getting more vulnerable, because nobody is monitoring. New risks keep on coming, and system could be subject to many attacks, because none of these elements where we have been seeing the cyber risk is being logged and reviewed and seen if somebody is trying to exploit that type of thing. So the auditor should also see how the logs are being reviewed, how the security incidents and event management is happening, how the various outputs which are coming from DLP tools or antivirus systems are being looked at, which all systems are getting blocked, and because there is a threat which is coming from a particular domain or particular rules which have been set by the organization. So those, and what actions the company is taking to resolve those types of things. So that is another element which they should look at. DLP, data protection and database security, that is another element which the internal auditor should clearly look at. Cyber incident and response, which is like how we identify, how do we monitor it, how do we resolve it, how do we learn out of it and make a corrective action and preventive action plan and implement that plan in future to prevent those types of incidents. That needs to be audited by the internal auditor. Then how the change management happened, how the codes are deployed, how the networks and wireless securities are being monitored, what type of network operation center and monitoring we are having, what type of advanced protection technologies which are identifying advanced persistent threats and taking a corrective actions on the same. What controls we have on the endpoint so as to prevent loss which is coming from due to endpoint being exposed. Then in training and awareness, because there are so many threats which are coming, there's so much of phishing attack which is happening. How we are training the people of the new ways of attack, how we are making them regularly aware and telling them that there is a possibility of social engineering, there is a possibility of phishing attack or identity theft, and making them aware and then raising it as an incident if they find something wrong. So that is another element which an internal auditor should audit. Then access management, how the access are granted, if somebody moves, how the accesses are changed, and then somebody leaves, how access is revoked, whether the people having access as to need to know basis, whether we have a zero trust architecture that needs to be seen. It is not only the access to the application, but access to the system to system, access from service to system. All these needs to be looked. Then phishing simulation, just to see if our people are trained how to resolve if such types of attacks happen. And then, of course, physical and environmental. So these are some of the domains, some of the areas which an internal auditor should look at while they are performing the audits. And typically, any audit which we perform, there has to be a root cause analysis. There has to be the reason why this thing happened, and based on that, a corrective and preventive action needs to be taken. And in cyber risk audit, this is a very, very essential step to do. Going to the root cause is a very, very important part, because it is not only prevent, because it's not a transaction, it is not a thing which will have a very small impact. Generally, all of this may have a huge impact because of the connected devices, because of one system exposing another system, and therefore root cause is very, very core to this cyber audit thing. And like typically what we have seen, I've listed out some of the observations which we see in the cyber audit, which is the IT asset not protected, because there is lack of ownership. There is no owner of that thing. The business has purchased the software and the IT is given to just manage it. And there is always an ownership conflict between the business and the technology people. Then sometimes passwords are not configured because our policies are outdated. Our policies now in the current environment, there are dynamic passwords which are there, and then there are ways in which the management of password happens through multi-factor authentications, through various types of things, and the policies are typically outdated and they are not aligned to the current systems which are there. then audit log's not available. Audit log often requires space. And if we are using outdated technologies where the codes were written years back, these things would not be available. So like fourth, there are many more things. Sometimes it could be a hard-coded functionality. Sometimes it could be that system feature itself is not available. All these root cause should bring a good insight to the board members, and they should look this as an input to replace the technology itself. If you are having an outdated technology, and when you are having these sophisticated attacks, then you are exposing your systems to various cyber incidents and cyber attacks, and nothing can prevent the organization from these types of things. So making that effort, understanding those root cause and taking corrective action should be the outcome of this internal audit. And one of the biggest findings which we have seen is lack of awareness and training at across the level. So this specifically need to be highlighted, because in technology, everyone is ear and eyes of the organization. Everyone is using it, and every person need to be aware, whether it is employee or vendor or customer. So that is another area which needs to be covered. So that's all from my side. If we have any questions, we can discuss that. Thank you.
Thank you, ma'am, for such an informative session. I'm sure our participants must have got a good understanding on key areas to focus while doing cyber security risk assessment and cyber audit. The questions have come up, but we will be taking at the end of the session. Please be with us. Thank you. I now welcome our next speaker, CA T. Sankar sir, for the next session. T. Sankar sir is a partner internal audit, governance and risk since 2014 in a leading chartered accountant firm based out in Mumbai, and also a member of Institute of Internal Auditors Mumbai chapter. Having a vast experience of around 35 years in setting up robust audit practices and control system, he has worked with several renowned companies such as Greaves, Orson Nihon, Fiat, Blue Star, and many more. He was also the chief auditor for nearly 2 decades. He is also a member of Lions International Club and managed around 105 clubs as district cabinet treasurer. I welcome you, sir, and request you to lead the session. Thank you.
Yeah, just a minute. Good evening. You're able to hear, no? Hello? Hello?
We can hear you, sir.
Yeah. Good evening. At the outset, I thank the Internal Audit Standard Board, CA Nandaji, CA Gyanchandra Mishra, CA Dilip Kumar Singh, and Gautam Buddha Nagar branch, CRC, for giving me an opportunity of the role of internal audit in risk management with special emphasis on strategic risk. Also thank CA Shivpriya for introducing me excellently. What is a risk? If we talk of risk is a part of everyday life, and the same is true for risk in organization. Pretty much every business contains risk. If someone comes and tells you that in my business there's no risk, he is just bluffing. All business contains risk. Some business the risk is high, some business risk may be medium or low. Even my firm, which I work, there is a risk is there. We may lose some clients. Every decision you make holds risk. The key is knowing how to do business in a way that protects you and allows you to manage business risk successfully. What is the definition of risk? Risk is any event or a non-event, the occurrence or a non-occurrence of which can adversely affect the objective existence of the company. This threat may be internal, external to the company, may or may not be directly influenced by the company, and may arise out of routine or non-routine action of the company. What are the perspective risks? Companies need to take risk to create value. If you don't take risk, you can never create value, and manage risk to protect value. Warren Buffett says, risk comes from not knowing what you are doing. as per Robert Charita, risk management is not about future decision, but about future the decision that we must take now. There are 7 types of risk: physical risk, strategic risk, compliance regulatory risk, operation human risk, techno cyber security risk, financial risk, reputation risk. And all this risk, when 2 or 3 risks combine together, it becomes a strategic risk. What is a physical risk? Suppose your plant, there's a flooding in your plant, a fire takes place, vandalism takes place, huge material is lost. That's a physical risk. What is strategic risk? Your top man takes a decision, and the decision may mar your company, or it may help you to grow the company, or you may have an excellent decision, but implementation not proper. That's a strategic risk. Compliance regulatory risk. Few years before, one in India, one of the state, one of the leading company, there was a leak of sulfur dioxide. And because of leak of sulfur dioxide, few people died, and the state government got furious. They closed the plant. Crores of rupees lost to the company. Had they done some mitigation process of sulfur dioxide before, this kind of loss would have never happened. Operation human risk. Yes, we may use artificial intelligence, we may use robo, but the most important thing, human being. You recruit a wrong senior person and he gives a wrong decision. It can mar your company. Just like a CEO, he gives a decision and that decision affects the company. Technology, cyber security risk. Yes, because of technology, I'm able to talk to all of you, all over India, but it has got also the risk. Our data can be hacked, production data, marketing data, employees data, etc. Financial risk. A simple example of financial risk I'll give you. Supposing your company depends 70% of business to one debtor, one customer, all of a sudden, and he pays in 2 months' time, all of a sudden, he makes a payment of 4 months or 5 months. Then your company is in a toss because you cannot pay to your vendor, you cannot pay to employee, you cannot pay to other suppliers. Biggest financial risk miss is ILFS Satyam. Reputation risk. Yes, friends, if the reputation of the company is good, people like to work in the company. The vendor like to do business with us. But if the reputation is bad, no, you cannot attract the best talent in a company. Vendor, even if he deals business with you, he will jack 10 to 20% more price. If you see in share market is the best barometer. 2 companies, identical, profit, sales, everything. But one company's share is very high and another company's share is low. Why? Because of reputation. Few years before, one Indian company, which has presence all over the world, one of the senior executive, brilliant senior executive, he was involved in sexual harassment case. And the Indian company has shelled out crores of rupees to come out of the case. In Dow Jones, in Indian market, the price fell down like anything. Now they have recovered. What I want to say is, you may recruit a best person, but if his character is not good, it may impact the company. What is a strategic risk? Everyone knows that a successful business needs a comprehensive and well-thought business plan. It's a fact of life that your best laid-down plan of today may outdated tomorrow. Why? I'm just giving example. Because it can be because of technological changes, a powerful new computer entering the market, shift in customer demand, spikes in cost of raw material, or any number of large-scale changes. History is littered with examples of companies that face strategic risk. Some managed to adopt successfully and others did not. There are 5 types of strategic risk: competitive risk, technology change, regulatory risk, political risk, and economic risk. What is a competitive risk? Number of years before, Hindustan Unilever, they thought they were monopoly. Then Nirma came. Nirma gave a run for Hindustan Unilever Surf. And Surf has to change the advertisement strategy, the product mix to compete with Nirma. Same happened. Colgate thought they were ruling the Indian market like anything. But Baba Ramdev Dantakanti came. They gave a run for Colgate. Colgate introduced a product only for India. There's one more risk in competitive risk. You depend on one supplier, and all of a sudden the supply is taken over by the competitors. Then what happens? Technology change. Yes, friends. Technology is constantly changing. What was technology yesterday is not technology today, and what is technology today may not be technology tomorrow. So we have to also to adopt to technology. Regulatory risk. Yes, this is one of the very big risks because you produce a lot of products, and all of a sudden government changes the regulation, and your product, crores of rupees worth of product becomes waste. That is why you have to be constantly monitoring the government regulation, everything. That is why if you see automobile industry, they constantly monitor the emission norms. Whenever the government changes emission norm, the small tweaking, they are able to do it. Political risk, yes. Nobody knows when the government will ban another country, export, import, everything. Like last year, if you remember, because of some war between India and China, Indian people wanted to boycott the Chinese product. Can we boycott a Chinese product? 70% of the imports are coming from China. We are depending solely on China. Why I want to say here is we should have an alternate strategy. In case tomorrow China is banned by Indian government, we should know in another country we should be prepared to import and export. Economic risk. The best example of economic risk is COVID-19. Companies which were prepared for this kind of scenario were able to survive. Companies which were not prepared could not survive. Take the case of airline industry, hotel industry, even automobile industry, luxury item. They all suffered huge during the COVID-19. Now, for an internal auditor, one of the most important things is a fraud risk. How a fraud takes place? Because of misappropriation of assets, manipulation, falsification or alteration of records, suppression or omission of transaction from records, recording of transaction without substance, misappropriation of accounting policy knowingly, financial fraud, material scrap, inventory, etc. How frauds are detected? According to me, based on my more than 35 years experience, more than 60% of fraud is detected through whistleblower or anonymous letter, through keen observation of internal auditor. Where controls are weak, red signal, there you can find out fraud. Thorough knowledge of industrial sector where audit is carried out. If a person has got thorough knowledge, he can easily find fraud. To get information from employee in a friendly manner. Certain suspicious income and expenses. Trend analysis, yes. Supposing you trend analysis means last year you see one expense and this year the expense is shot up like anything. It can be genuine also. Or income, last year income and this year income, there's huge difference. So you should analyze, is there anything problem or not? Past audit reports, questionnaire. I have a number of examples in fraud, but I will give 2 examples because of paucity of time. Few years before, when I was working as head of audit in a leading manufacturing company, and when I visited one factory for a factory audit. Normally, when I go to a factory, I don't sit in an air-conditioned cabin. I make a round of the factory to see how production takes place, how scrapyard is maintained, how inventory is maintained, stores, everything. So while making a round, one of the employees from the factory came to me, asked me, "Sir, are you head of internal audit?" I told, "Yes, I'm head of internal audit." "Sir, I want to talk to you confidentially." "Yeah, come to my cabin, we can talk confidentially." "No, sir, I want to talk to you here." I told, "Okay, talk to me." "Sir, do you do audit or scrap audit?" I told, "Yes, we do scrap audit." "Sir, what I understand, you carry out scrap audit only with the rate, not with the scrap generation. Why, do you have any doubt?" "No, sir, you should also do scrap generation." And he went away. This triggered me. What he said was right. Because we were doing scrap rate audit, we used to get quotes and we get the best price in this plant. It is a 500 crore plant. And somehow we have not been doing audit of scrap generation because we had high faith in the plant in charge. So this triggered me. What I did, I have colleagues in my other industry, the same field, same company, like this. So I checked with my colleagues for this kind of company, what should be scrap generated. They all told should be around 3 to 3.2 crores per annum. Then I had a friend who was a production manager in this plant and you are shifted to another plant. I asked him what should be the scrap generation in this plant. He told, I don't know about the value, but I can tell you about the quantity per annum. So he gave me the quantity, which I multiplied, which was coming to 3 to 3.2 crores. Whereas we were getting from this plant only 1.4 to 1.5 crores. I was shocked. So I went and met the MD and chairman and appraised him and told him, sir, I want to do a in-depth audit of scrap. I will take a help of a technical person from another plant. Luckily for us, sir, the plant head has gone on leave for 1 month because of his daughter's wedding. So easy for me to do audit. The MD and chairman gave me permission. So along with the technical person, I went in the plant. I stood for 15 days in the production yard to see how much scrap is being generated. Morning 8 o'clock to night 8 o'clock. And I got a reasonable idea. On one day, on the 14th or 15th day, one lorry, a truck with having 16 metric ton and fully scrap was loaded. It was going out. I stopped the truck and checked the challan. The challan showed 4 metric ton worth of GS scrap, MS scrap. But the truck was full. So I had a doubt. I went to the weighment bridge and weighed again. And it showed 14 metric ton worth of scrap. That 14 metric ton of scrap was going, and we are showing only 4 metric ton of scrap. Then I called the scrap vendor in charge. And I asked the security in charge also to be with me. And we told him that, see, the challan shows 4 metric ton, whereas you are getting 14 metric ton. You are doing fraud with our company employee. I will hand over the police if you don't tell the truth. Initially denied. Finally, he agreed that yearly he is getting a scrap worth of 3 crores, but 1.5 crores only billing is done by the company, and 1.5 crores he give cash to number 1 plant head. How he shares with other 3-4 people, he has got no idea. I told him to give in writing. He gave in writing. So when the plant head came, we interrogated, but he refused. We had to sack him, and few other people were sacked. One more live example I would like to give. A lot of people feel physical verification of inventory or raw material or spare parts is a mundane activity. Nothing will find. But I want to prove here, in a physical verification also, you can find a lot of things. Few years before, I decided to do a physical verification of a spare parts warehouse along with my team. We went there in the middle of February. That's a lean season. I told we want to do a spare part verification. We started doing verification. At that time, I told him, give me top 25 items. Item wise highest value and top 25 item total value. So they gave me a list of 25 items. While checking it, I saw one item, one plastic board. There are 4,000 pieces, which is costing 1 crore 40 lakhs, and 1,000 pieces already been issued 35 lakhs. And that plastic board, if you see on the road when people are working, a yellow plastic board, men at work, and that plastic board with the company logo embossed its rate was 3,500 per piece. I was shocked. How can be this 3,500? This plastic board looks not more than 300 rupees. Normally, this plastic board is given free to our dealers, 15 plastic board per dealer, because they work on our site. But 3,500 for one plastic board? So I told the warehouse in charge, give me 2 plastic board in my name, debit to my department account, and he agreed. Because we have an authority that we can take material from any warehouse for up to 50,000 and get debited to our account. And if we don't return it in a month time, it will be debited to my salary account. So I took the 2 plastic board. I took the help of my friend. I went to a plastic manufacturer and asked him that we want to buy 5,000 plastic board of this with the company's logo embossed. What will be the cost? He told me, sir, if you want 100 board, I would charge 500 rupees per board. But since you want 5,000, I'll give you 300 rupees. I told, give me in writing, then I'll put up to management for buying this board. So he gave me in writing. So I met the MD and chairman, and I told him that, sir, along with the plastic board, I've also analyzed one more item, a voltage and stabilizer, which was costing 1,100, but he has purchased a 2,100 from the same vendor. 1,000 rupees for 2,000 comes to 20 lakhs. So totally, this fraud is 1 crore 80 lakhs. I told MD and Chairman. MD and Chairman was surprised. He told Shankar, he was a VP of the year twice. And he's a brilliant person. How did he do it? Sir, all frauds are taken by only a brilliant person. An average person can never do fraud, I told him. Sir, I told you last year, sir, there's no maker-checker concept. He's only procuring the material. He was only receiving the material. He's only issuing. The risk is involved. You told, okay, we'll see later on. Then MD Chairman gave me permission. So I told the CFO and the security head to be with me. I called the vendor and the vendor came and vendor initially refused. Then I showed the another plastic manufacturer's letter. I told him we will hand over to police if you don't tell the truth. Finally, he agreed. He told, sir, the board cost only, plastic board cost only 300 rupees. But your VP material spare parts told me, you take 500 extra 200 rupees and pass me 3,000 rupees. Same manner for the voltage stabilizer, take 200 rupees extra, 1,100 plus 200, 1,300 and pass me 800. So that's what happened. I told him give in writing. He gave in writing. Then luckily for us, 90% payment were not made. So to the vendor. Then when the VP material, spare part material came, we interrogated. He didn't agree. We had to sack him. How to develop fraud risk assessment framework. Identify relevant fraud risk assessment factors. Based on risk, high, medium, low, identify potential fraud scheme possible in organization. Map all the existing controls and identify gap where fraud is possible. Operating effectiveness testing of fraud prevention and detection control. Document report fraud risk assessment. Top 5 risks, according to me. One is merger and acquisition, fraud and ethics, large program, new product introduction, business continuity. Here, I would like to give an example on strategic risk, due diligence audit in acquisition. This was done by one of my very close friends in Delhi. He was head of audit in a leading manufacturing company. For confidentiality, I'll say as if I've done it. Once, my MD and chairman called me and told, Shankar, we are planning to buy one skilled labor company for 100 crores. This company, myself, the president, marketing, others, we have done a very good due diligence and we feel 100 crores is worth buying because it will increase our company's turnover, bottom line. But still, I want you to do an independent study. Then I told the MD and chairman, sir, if you people have done a detailed study, why do you want me to do a study? I'll be using 3 of my people and also use external agency. It'll cost 5 to 7 lakhs. Why do you want me to do study? MD and chairman told me, Shankar, you don't worry about all these things. I want you to do a study. That's all. Now, who can argue with MD and chairman? I came to a place. I called me 3 best CAs and told him that we have to make a study in 25 days' time. And I told him, and we started collecting data from Google, from my colleagues and everything, discuss data. Then we went to the company. We saw the books and everything. We took the external help. And in a 25 days' time, we were able to do a very good study on the company, skilled labor company. And I sent an excellent report, hard copy and soft copy. Here I would like to say, your content may be excellent. If the presentation is not good, the content loses some value. It is like you like to have dessert or a salad in a 5-star hotel, even if you don't like it, because the presentation and the dressing is superb. But in an ordinary hotel, you never like to have a salad or a dessert because the dressing presentation is poor. So next day when I met the MD and chairman, the first thing he asked me, Shankar, do you understand business? I told, sir, I understand business very well. If you understand business, we want to buy the company at 100 crores and you are suggesting 70 crores, a maximum 72 crores. I can understand if you suggested 95, 96 crores, I would agree, but not at 72 crores. Sir, see my report. It is crystal clear. Debtors are overstated by so many crores. Creditors are understated by so many crores. Liabilities are understated by so many crores. So many employee liabilities are not booked. Assets are overstated by so many crores. Inventories are overstated by so many crores. Few skilled laborers have already left the organization and few laborers are in the pipeline of the organization. Considering all the facts, 72 crores maximum we can buy, sir. More than that, I do not recommend. The MD and chairman saw me for a minute and told, okay, Shankar, thank you. And I came to my cabin. I felt very upset. In spite of doing excellent job, myself and my team, the MD and chairman brushed me like anything. After a month's time, I came to know we purchased a company 10 days before for 80 crores. I was surprised. So I fixed an appointment with the MD and chairman and met him and asked him, sir, you told me 72 crores is not practical at all, but you wanted to buy 100 crores. Now you have purchased 80 crores. The MD and chairman saw me and smiled at me and told, Shankar, when I told it 100 crores, that does not mean I'll buy it 100 crores. We also wanted to do negotiation. We thought we'll buy a 90 or maximum 88 crores. But your report gave me a value addition. We negotiated with the vendor. We showed the report to the party. He initially disagreed, but some other point he agreed, and he gave maximum 80 crores he can buy. We also thought it's a win-win situation for both of us. So we agreed for 80 crores. Shankar, thank you for you and your team for have done for an excellent job and helping the company in 8 crores. What is a strategic risk and what is the difference between strategic risk and operation risk? Strategic risk can come from both an internal and external forces, where operation risk comes only from internal process within a business, especially when they stand to disrupt workflow. We can say strategic risk is about what you do and operation is how you do it. Impact of strategy is far greater in comparison to operation risk. Static risk management is a process of recognizing risk, identifying the causes and effect, and taking relevant action to mitigate them. As already discussed, risk can come from inside and outside the organization, such as manufacturing failure, economic change, shift in consumer taste, etc. How do you identify strategic risk? In that understanding of organization, yes, you should have thorough knowledge of organization if you want to do strategic risk. Your target audience, who are the audience? Below 15 years, 15 to 25, 25 to 40, 40 to 55, above 55. And what income group? High income group, medium income group, low income group. What is the market sector you're operating? Who are the competitors? And which environment your business operates? And you should have clear awareness of your organization core strategic goals from conception to proposed execution. I want to give some few failure stories, then success story. 88% of Fortune 500 company as of 1955 have become bankrupt or merged or out of 500. Why? Main cause of this downfall has been identified as a non-implementation strategic model entirely on the screw sets. Kodak, which was formed in 1888, became bankrupt on 2012. It was a pioneer photo company in the photography space. Why? In 1975, one of the senior executive did a patent for a digital camera, but the Kodak did not want to go digital camera because it may impact the photography space. And Canon came and digital camera lost the case and became bankrupt in 2012. Blockbuster, which was 6 billion revenue at peak. In 2004, it had 10,000 stores and 94,000 employees. And 2010, it became bankrupt with one store. You know, Netflix wanted to sell for 50 million to Blockbuster in 2000, but Blockbuster did not buy it. And Netflix became the competitor. And now where is Netflix? MySpace was one of the most dominant social networks. And today, after Facebook comes, where it is. We can argue these companies failed to innovate, but I would argue they failed to see the iceberg ahead. In other words, they failed to manage strategic risk. ITC is a clear example of success story of excellent management strategic risk. On 31st March 21, they had a revenue of 55,788 crores and income of 13,390 crores. Why? They survived because of excellent strategy. What strategy did? 40 years before, they were only making tobacco, and Indian government was every year they were trying excise duty. And ITC thought if they had to survive India, they had to do diversification. So they diversified into FMCG, hotel, paper industry, packaging, IT. And now in 21, that from 100%, 40 years before, they are now 43% only total revenue from tobacco. FMC account 25%, balance from other sectors, although they hold 77% share in tobacco industry. Had they not diverse, they would have become a blockbuster. 3M. If you attend any medical conference, the first example they give is a 3M. 3M is an American multinational company which has a presence in the field of industry workers, safety, consumer product, nearly 60,000 products they're having. It's a classical example. On 31st March 21, it had a turnover of US dollar 35.40 billion and net income of 9.592 billion and having nearly 1 lakh employees. What is the strategy they do? Every year they add a new product. Even if it is a very small product, they add one product every year. And the policy is not to exceed certain percentage share in each product so that the risk is evenly divided. One more example, win-win situation example, is Ramesh Chauhan, Thumbs Up company. He's Thumbs Up, Limca and Cold Spot. He sold for 60 million in 1993 to Coca-Cola. Why did he sell? Because Pepsi and Coca-Cola came to India and he thought giant two multinational company, along with them, he cannot compete with them. It's better to sell and come out. So he sold the company and it's a win-win situation. Here, I would like to also give a report drafting risk. Why I'm saying, as an internal auditor, one of my number 2 man, he had excellent content, but because of the poor drafting, he would have lost his job. Why? Few years before, along with my wife, I'd been to abroad for 15 days holiday. During that time, I used a local SIM card. I don't use the Indian SIM card. So my number 2 man did an audit in a procurement in a big branch. And he found a lot of control weaknesses. So he wanted to get in touch with me, but he could not get in touch with me. So he thought better to release a report. He reported a flash report, CC to President MD and Chairman MD and President Procurement. In the report, he mentioned the controls have collapsed. The President Procurement was furious. He spoke to Chairman MD and told, sir, the internal department's writing, the controls have collapsed. Do you mean to say we are running an organization without controls? You know very well, Chairman MD, they are more soft corner towards the operation head than the support function. He told, don't worry, Shankar is coming to India after 5 days. I will ask him to look into it. So when I landed in India, the first thing I put local SIM card, I got a lot of messages. The first message I saw was MD and Chairman. Shankar, please meet me in my early office tomorrow sharp at 10 o'clock. I know there's some problem is there because otherwise he will never call me the next day after my holiday. So I met him on the next day at 10 o'clock. He gave me the procurement report. Have you gone through the report? No, sir. Read the report and tell me. I read the report twice. He asked me, what do you feel? I told the content is excellent. He has done the content. A lot of contents are there. But the drafting of the report is not proper. He asked me why. Sir, he has written controls have collapsed. That is not right. No, there are a lot of big controls. But he also mentioned there is a purchase order is there, authority level is there. So you cannot say controls have collapsed. This is what the MDHM told. The President Procurement has informed me that internal department don't understand their written controls have collapsed. I thought of sacking your number 2 man, but this is the first time I thought we have given a warning to him. I want you to do a damage control exercise, but end of the day, I want you to redraft the report and release the report. I said, okay, sir. I came to my church office. I called my number 2 man and I asked him, why did you draft like this? He said, there are no controls, sir. No, controls are not there, but there are a few controls. You can't draft like this. So you leave it to me. I redrafted the report. I released the report and CC to President Procurement and CC to MD and Chairman. After an hour, the procurement president called me and told, Shankar, you are drafted very well. You are absolutely correct. The control needs substantial improvement. And you have also suggested ways and means how the control can be improved. And definitely after 6 months, when you come for audit, you will see a lot of controls are improved. Even the President Procurement also appreciated me. But here I'll tell you, the control needs substantial improvement and controls collapse. Both are same, but the way you put makes a lot of difference. And secondly, you should also suggest means how the control can be improved. Can you imagine that person learned a lesson, and today he's a senior vice president on a leading manufacturing company. Role of internal in risk management. The focus of internal auditor should be provide assurance on the effectiveness of risk management, not on just on the effectiveness of control. This is an important distinction. It is insufficient to say that internal controls are inadequate or adequate, or even to say that there are high risk deficiency. Internal audit need to communicate the assessment whether the management is appropriately addressing more significant risk to the achievement of specific objective. Process for the management of risk must be integrated in the organizational system of management to be effective. Some companies' top management, including board level, expect internal function to carry out audit of process of strategy risk management. Some companies of top management, including board level, expect internal function to carry out both content of strategy risk and audit of process of strategy risk. Which company I was heading as an audit head, the management had enormous faith and they were allowing me to content of strategy risk. Why they allowed me? Because I have thorough business knowledge. Friends, whoever wants to do a strategy risk, you should also, the top management should have confidence in you that you can do content of strategy risk, and that can come only if you have thorough business knowledge. What are the audit challenges? Internal auditors should be risk-based, not on transaction-based. Harness data analytically and use data in planning process to structure audit that adds value. Ensure governance risk and compliance risk as integral part of ERM. Think smarter way to use technology. Ensure strong internal controls are in place with downsizing is there. Yes, when downsizing is reality, there should be strong internal control. Move to continuous auditing to make internal audit more strategic part of business. Internal audit should think and act more creatively. Integrate fraud detection and prevention into internal audit strategies. Develop strategy to recruit people from non-traditional areas like engineers, commercial people, legal people, so that your audit department, strategy department is more better. Challenge the status quo. Greatest difference between the existing and the emerging model is a strategic analysis and business processes. See, control is no doubt important, but there are other things. Supposing if it's impact the business, like McDonald's, for them, the quality of French fries, the speed of delivery, and the cleanliness of the restaurant are far more important than 10,000 deficient some cash register last month. Internal auditor business performance assessment should assure that key business risks are being identified. Transform internal auditor strategic advisor. What you should do, look beyond processes and controls. Play an advisory role in the organization. Identify enterprise-wide cost efficiency. Provide strategic insight that improve business performance. Provide key insight that focus on the risk that matters. What are the qualities required to conduct risk audit, including strategic risk audit? Effective relationship building requires several attributes, including business acumen. Time and again, I'm saying business acumen. That means you wear the hat of an operation head, not as a hat of internal audit head when you do a risk audit, including a strategic risk. Knowledge of the company. Yes, you should have thorough knowledge of the company, including what are the risks the company will face. Persuasion, empathy. Internal auditors should be able to walk in the shoes of the people working function the audit. Yes, if you want to do an audit, you should be walking the shoes. That means, suppose you want to discuss with the purchase department. You should be thorough in you and your department people should be thorough in the purchase department. Then only you can do a risk audit of purchase department. You yourself don't have knowledge in purchase department. How can you do an audit of purchase department or a finance department, etc.? These 5 qualities are very important. Analytical and critical thinking, communication skills, data mining analytics, general IT knowledge, business acumen. Time and again, I'm saying business acumen. And when I talk of communication skill, I'm not only talking of oral and written communication skill. I'm also talking of communication skill. We audit heads, we are very bold. We talk equally to equal level and below level. But when the top level, we are a little scared. I know a lot of audit head. When the president marketing or president production or the material says, drop this point, they sometimes drop the point. Why should we drop the point? If it has got some meaning, we should try to explain to him and try to improve the process. You see, my friend, he was very bold, the chairman MD. He was stuck to his point. The company can be purchased only 72 crores, not at 100 crores. Risk assessment identifies all the risks related to the organization, Identify the risk bonus. What is risk bonus? Assess the impact and likelihood of risk. Well, what is the impact? Supposing risk 5 is highest level, 1 is lowest level. Suppose the impact is 5 and likelihood is happening 5. That's very high risk. It's called 5-5. But 5 is impact. Likelihood is 1. Or likelihood is 5. Impact is 1. 5-1 or 1-5. That nothing, not much to worry. So you should see the risk assessment. 5-5, 5-4, 5-3, 5-2, 5-1 like that. Determine the level of risk, whether it is high risk or high risk, medium risk or medium risk, or low risk or low risk. Decide whether risk needed to be treated or not. What are the different risk assessment in internal audit? The main difference is a mindset. Risk assessment thought about the event that could happen in future event, whereas internal audit deals with the which is past event. The second major difference is internal focus on compliance with various rules and requirements. Well, risk assessment, nothing but analysts that provide a basis for building up certain rules. Third difference is risk assessment done before you start applying the security control, whereas audit is performed once they are already implemented. Risk management plan, what all do? Identify potential risk. What are the risks in the business? Some business risk, some may be business-wide and some may be certain sector-wise. Conduct a risk analysis. Once identify business risk, conduct risk analysis. What is a potential impact likelihood? Like I told you just now, 5-5, 5-4, 5-3 like that. Identify warning signal and agree to key risk indicator. Yes, see the warning signal. If you get a warning signal, just like supposing somebody has got authority of purchase order 50 lakhs. Supposing if he's issuing 55 lakhs, and this should pop up, the system should pop up saying that 55 lakhs you do not have authority. See the warning signal and do accordingly. Identify preventive measures. Yes, mitigation process, do it. And assign responsibility. Yes, when you do assign responsibility, assign to a proper person. If the purchase function and purchase risk register, you assign to a person who knows purchase function, not to an administrative person. Similarly, with the finance function, if you assign a risk register, assign to a person who understands finance. Now, I want to give one operation risk area a walkthrough very fast. What are the HR department have? Recruitment, training, organization structure, manpower planning, salary structure, role and responsibility, goal definition, care and documentation. Then I'll take a recruitment. What is the operation recruitment? Suppose you do incorrect recruitment. What is impact? Outcome, result not as per plan, cost salary, you pay for inefficient person, high salary, opportunity cost, time loss by recruiting wrong person, impact on the team model become very low, wrong person, impact on the overall environment, company image and reputation. Suppose you recruit a wrong CEO, the image of the company can become. What are the mitigation process for recruitment? Job description, documentation, sourcing of CV, screening of CV, candidate profiling, competency mapping, background check, fitment check, interviewing process, selection panel, hiring process, overall review. Now, if you want to do tool resources, these are the risk identification tools. These are the tools according to me. Questions and survey, facilitate risk identification session with process owners, auditors business knowledge, strategic and tactical business objective, discussion with the legal department, regular legislation, review of business publication, economic time, financial expert, other business magazine, previous audit report, industry report, and benchmark information. Friends, when I always close my talk, I would like to give, based on the 35-year experience for risk management, strategy, risk, and internal, some practical tips. The first practical tip, don't sit in centralized AC office. Go to site and factory. Yes, people. If you sit in the centralized office and do laptop, you cannot get everything. Please go to site and factories. You will learn a lot of things. I've gone to a site in northern region, Chandigarh, 46-degree temperature. And in a porter cabin, I worked for 15 days with roadside tea, roadside food, even accommodation for. But I learned a lot of things. What is the scrap generated? What is input-output material? A lot of things I learned. How many laborers should be employed with this 100 course project, etc. Here I'll give you one example. Few years before, I went, when I was going for one region, I went to one warehouse. And that warehouse was outsourced for keeping our materials, huge materials, like air condition or water cooler, etc. And the stacking norm was, I have seen the agreement, 1+1. because we are given 1+1 so that damage should not take place, and last in first out will be issued, not in first out. But I was surprised that they were stacking 1+3, not 1+1. And 1,000 square feet was the area they were billing every month, whereas they were using only 500 square feet. And they had 5 warehouses like this. We checked all the warehouses. And they were billing 1 lakh per month, each warehouse, 5 warehouses, 5 lakhs, whereas they should bill only 2.5 lakhs. Further, there can be damage for our product. And also, first in, first out issue will be done instead of last in, first out. And can you imagine 30 lakhs worth they have billed last 1 year? We took up the issue and we got back the money. IA head, do 1 job independent per quarter. Yes. And this advice is for all internal audit head. When internal audit head, when he is an officer, assistant manager, senior manager, he does a lot of audit. When he becomes an IA head, he does not do an audit, he just reviews the audit. But friends, if you want to be a good IA head, you should do once a quarter, because then you get a pulses. I used to do once a quarter any project audit or a warehouse audit or a material audit. Then I know pulses, what are the weaknesses in the project audit, in the warehouse audit, a material audit. Third advice I would give, be a friendly policeman. Yes, you have to be a policeman, but be a friendly policeman. Don't be an arrogant policeman, because you are helping the auditee to improving control, processes and system, except the fraud. Other things, you are internal auditor, strategic risk auditor, you are helping the auditee. So you have to be a friendly policeman. You won't believe whichever company I work, I have received number of request audit from operating head to carry out audit, including risk-based audit. The chairman himself was surprised. How says, Shankar, you are getting a lot of request audit, because we were helping them to improve the control, process and system. The fifth one, think like a thief in respect of control weakness and other process weakness. Friends, don't become a thief. I'm just suggesting, think like a thief, because if you think like a policeman, you will have control and checklist. But when you think like a thief, you know what is the weakness in control. Supposing in a procurement, you want to do a fraud, somebody want to do a fraud. So if you think like that, if you want to do a fraud, what are the control weaknesses? Then you will come out with 3-4 weak controls, which you can suggest to the management. Never compromise your integrity. Yes, this is applicable to all departments, but for internal it's more important, because we find fault with others and we say he has done a fraud, he has done mistakes, everything. And our integrity is not good. We have no right to comment on others. I'll give an example, short example. Few years before, number of years before, I wanted to buy a land in Pune around 30 lakhs. And one of the plant head came to know that I want a land. He told me, Shankar, my very close friend is there, he will give you 25% discount. Why don't you buy the land? But somehow my conscience did not permit me the recommendation from the plant head, because tomorrow I can't do independent audit. So I didn't take the offer. And 7.5 lakhs worth of discount offer I didn't take. And thank God, after 8 months, I have to do an audit, scrap audit, which I mentioned, 7.5 crores worth of loss to the organization. I had to do an audit. And I was able to do boldly because I had not taken any favor from him. Have your eyes and ears open. Yes, very important. Because you should keep your eyes and ears open. You can find a lot of things. Here also I'll give last one example and close the session. Few years ago, I went to Calcutta to do a project audit, to review the project audit. So when I was in Calcutta, normally the office time is 9:30 to 5:30. I go half an hour before. So I was allotted one vice president cabin because he was on leave. So I was sitting here. I was seeing the notice board, leave notice board. I found 14 holidays shown, and 14 holidays right. We have company policy, 8 mandatory holiday, 4 optional, 6 optional holiday. What is the 8 mandatory holiday? Like if it comes August 15, January 26, October 2nd, they're all fixed holidays. Irrespective which falls on a Saturday or Sunday, it should be given as a holiday. And 6 optional holiday is taken by the union. But the second time I saw the notice board, I saw all the 14 holidays were there from Monday to Friday. I was surprised. And I saw, luckily for me, I have 5 years data of all the locations. So all the regions, including our regions, this year we had only 10 holidays. 4 was falling on Saturday, Sunday. And I went back also for last 4 years. And all the 4 years, we are getting 9 days or 10 days. Whereas Calcutta or Eastern Zone was getting 14 days holiday. But before 5 years, I checked, they were also getting only 10 days holiday. So this, I understood the modality. So I went to my Bombay office. I spoke to my chairman, MD, and the president, HRD. He showed him, and he says he was not aware. And we called the HRD. He says, no, sir, union wanted. So that's why I did it last year after my joining. The chairman, MD, got furious. He told, this is not the way you run a show. He was actually, HRD was sacked. That day it was the month of October. We didn't change the leave. But from next year, there were only 10 holidays. No doubt, the union was furious, but nothing happened. After that, everything was okay. And last is, all your audit findings should have solid evidence supporting paper. Yes, only when you have solid evidence supporting paper, only do an audit and say a clear report. Don't say on a hearsay, or if he's wearing a BMW, he's driving a BMW car or a Merc car, you don't say he has done a fraud. You should have solid evidence and support. Finally, when I close, I wanted to close. I'm a strong believer, Swami Vivekananda. I'll give a quote. Strength, 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 what we need. We can do anything and everything. Uttishta jagata prapayavara nibota. Arise, awake, and stop not till the goal is achieved. What I want to say, friends, we as an internal auditor should get the confidence of the top management that we are capable of doing strategic risk audit. The content also, not only the process, the content also. For that, you should have thorough business knowledge. Thank you once again for Internal Audit Standard Board and the participant. And whatever question you want to ask, you can ask at the end of the session. Over to you, Shivpriya. Shivpriya, over to you.
Thank you, sir, for such an interesting session. It is always fascinating to gain knowledge that has been well through live experiences. We are extremely thankful that you have shared your valuable experiences and learnings, which we as young chartered accountants will take our own time and efforts to gain in professional journey. Thank you, sir. Moving ahead with our last speaker of today's session, CA Sudeep Modi, sir, an Associate Director at Big Four and CMA rank holder. He is associated with Big Four since last 10 years, with vast experience on process transformation, audit, and technology development. I now request him to lead this session. So,
thanks, Supriya, for the introduction. I'm glad to be a part of this journey and share my experiences with the CA fraternity. And it has been a good opportunity for me as well to be I've been an active member and share my all experience and whatever I've gathered over the years. And I'll be looking forward for such more sessions. Meanwhile, I'll just start off with the ERM thing, and I'd like to share the screen and share my experience and knowledge, whatever I have gained during this last 12 years. I'm glad to tell that I have done some ERM engagements for about 4 to 5 companies, and all are leading in their own domain. And these are all listed companies and are doing well for the Indian economy. Just open. Is my screen visible?
yes, sir, it's visible.
Just a second. I need to swap. Just a second. I'm not too familiar with the Zoom, but then is the screen I'm able to navigate?
Yes, sir, we are able to see you. We are able to see your screen also.
Yeah, sure. Starting with the ERM. So ERM is Enterprise Risk Management. Enterprise Risk Management, so audience should not get confused with the Strategic Risk Management and Enterprise Risk Management. So Enterprise Risk Management is not just a one-time activity or a way of identifying certain risks, but it is more to do with the overall framework. It has to do with more of a culture of the company, their capabilities and the practices, which has to be integrated with the strategy and the performance so that they can manage the risk and create value and preserve the value for the company. So how to further elaborate, it is a more of a performance-based process and through which we can allocate the resources to manage the risk to achieve the desired objective. See, the entire fulcrum point or a magnetic north is the business objectives. So for any organization, a business objective is very key. So tomorrow, if you have to increase by 10 scale, you have to set a business objective. Your strategy should be there. So what is the risk? Risk is the uncertainties which are there in order to achieve the event which can happen, which can derail you from achieving your objectives. It can be positive, it can be negative. So the important point is to have a business objective. So in my experience, what I have seen, many companies does have a vision, everything, but their objectives and business strategies are not clear. So if you don't have a business strategies and objectives not clear, then risk assessment exercise is largely an operational activity to identify some functional risk, but then it doesn't serve the major purpose of it. For example, if you have to open increase your turnover by 3 scale, you have to set your objectives accordingly and your risk appetite, everything accordingly. There are going to be bad debts. There are going to be discounting. Your profits may decline. So you have to set your objectives straight, and then you have to accordingly set your risk appetite, everything. So this is a key fulcrum point. Now coming to the second bullet, so it is a business tool. It cannot be merely a compliance exercise. Although there has been a requirement on the compliance side that companies has to comply with it. So for Indian industry, for Indian thing, in India, any company which is top 1,000 companies in the stock exchange has to have an ERM function. So this should not be mere a compliance tool, but it should be a business decision making tool. So it helped. So in my experience, that has really helped organization in making an informed decision making. I'll give you some illustrative cases about it, and we in our public domain will be able to relate to it. So again, so how we go about it? There are certain standards. One of the standards are in the ISO 31000, so which we generally use for the guidance purpose for risk management. And another standard is the COSO, Committee of Sponsoring Organization of Trending Commission. So why? The question is why ERM? So it helps us to identify first what are the risks. Every company will have a different risk based on their company profile, their objectives, where they want to move, their capability, and the culture. We have to see all to identify the risk. Now the second point is a particular risk across the organization, for example, attrition risk. Is it particular to a design department or is it particular to a sales department? Attrition has been a challenge during recent years across the industry. So you have to perceive where it is. It is at operational level or strategic level. Whether it is a significant risk. Again, everything has a risk. Whatever you do in your life, there will be a risk, and we, by inherent nature, consider them while we are doing any activity or doing for any decision making. But is it really significant? That can have an impact on our objectives. Then who owns the risk? For example, health and safety department. For any safety related risk, health and safety department has to own the risk. So that risk mapping has to be done to the risk owners. So the probing questions are answered by the ERM. Again, it is more of a framework. It is not a mere one-time exercise. The next point is this exercise also helps us to understand whether there has been any mitigation plans to mitigate the risk. For example, a chemical company will have, for the first risk will be health and safety, whether they have an adequate framework to mitigate any calamities like Bhopal gas or something. Do they have a mitigation action plan? Is that comprehensive? It should not be like, for example, cyber. Many companies, there are cyber risks. Many companies does have a framework, but then they don't have a BCP plan which is quite workable. So is that plan comprehensive and adequately getting tested? And who owns a mitigation plan? See, there is a difference between risk owner and a mitigation plan. For example, attrition. Attrition is risk for an IT industry. It may risk owner is an HR department, but then mitigation plan has to be involving more department. It has to have a business side of it, management side of it, HR side of it. So again, for every risk, the mitigation plan needs to be owned by, and there are risks where mitigation plans are owned by multiple people. So our thought process should be more diversified rather than focusing on a linear things. Now coming to the next thing is are we able to manage the risk? Is the information timely available to manage the risk? For example, pandemic. So I was doing a review in 2020. I'll share my experience. So I could see for a big IT company, I had done a review. They had this information that China had this COVID alert. Okay, they had a strong BCP plan available, but then only thing is that information was there, but then what I noted, they had the response time was there quite alert. Their response time was there every day. Even rain in Chennai is getting tracked by them in the BCP plan. So every time there's an event, they capture it. There is a repository, and there's an action plan. Whether it's impact, everything is assessed on a daily basis in an IT company, because they provide very critical services to the other banking industry. Even our shut off may really impact. So that timely information is gathered, and whether they have whether it is being managed. Again, based on the risk, they are escalated and reviewed. And most important thing is emerging risks. So a pandemic is again a beautiful example. Tomorrow, earthquake may be an emerging risk, or a carbon credit, something like ESG norms. ESG norms, cyber security, these are two emerging risks which is affecting most of the companies. With something like emerging risks are ESG norms. So you can really have a related example in the industry where with the ESG norms getting more and more stringent, you can clearly see how the companies are diversifying the portfolio. Reliance Industry has been an eminent example where they're diversifying the portfolio from petroleum, oil and gas to media, technology. They had perceived this emerging risk long before, almost 2 decades ago, and they had built a plan around that. So it is very important to keep a track of emerging risk. Emerging new competitor or a government, tomorrow there may be n number of scenarios where you have to track the emerging risk. So it is a key element in entire ERM framework management. So again, the question is from the compliance point of view, why ERM, and who should be in compliance with who should have this ERM framework? So ERM definitely, as per from the risk mandate and the compliance mandate, Section 134 clearly requires the board of directors to ensure that there is a risk management policy and whether risks are identified which has a threatening impact on the company. So that is one clause. Another, the audit committee has to evaluate the risk management systems, whether the company has adequate risk management systems to mitigate the risks. Even independent directors has to satisfy themselves whether the risk management system is robust and defensible. So this has been a new development in the recent years post Companies Act 2014. They have been included. So more and more independent directors are active to identify whether there has been any probing, any emerging event which may impact the going concern or have a significant impact on the business from not just from financial front but operational front as well. So again, from the listing agreement point of view, we can see clearly that companies are required to maintain the risk assessment framework and a constituted risk management committee. So with the recent amendments in May 2021, we can clearly see the ambit has been increased from 500 companies to 1,000 companies who are required to have a ERM framework and a risk management committees. The new provisions has been laid out wherein ERM the structure of the risk management committees, mandatory meetings, quorums, role responsibilities, and even appointment of chief risk officer is mandatory for top 1,000 companies. So this is the thing. So far as we as a chartered accountant has now new avenue where not just as an internal auditor of finance, we can also have a major role in as a chief risk officer. That is a new position which is now many companies are looking to fill for. So a case study, I'll just highlight with a case study to make this session more interesting. So this case study is a long back in during when Infosys had a high in early, almost 2 decades or 15 years ago, when Infosys had a real heavy dependency on the General Electrics. So they had the customer base. They were almost the largest customer for the G, and G had its own issues. So what? Almost 1/3 of the revenue came from General Electrics. So the board had decided that they had to reduce the dependency on G to 1/10 of the total revenue, and they did it. They diversified into the various domain, product development, and Finacle, and they had done a lot of strategies to ensure they diversified. They had entered into new territory, European territory as well, and other countries, African countries, European countries, to ensure their dependency on one customer is not there. And after a few years, what we saw that G suddenly wanted a rate cut. And at that time, Infosys was in position to show them that was in a position to negotiate with them. And even right now, Infosys continue their wonderful journey and is on one of the leading IT companies in India. Similar case studies we can see in Reliance Industries. I clearly remember with we all can relate with this examples where Reliance Industry has clearly diversified its portfolio from oil and gas to media, retail, telecom, and green energy. And now, as a new sector, he is entering into a new green energy, including hydrocarbon, including solar and hydrogen. So this clearly shows how companies think, how they evaluate and consider risk management as a key activity. So with this Kyoto Protocol and Copenhagen Protocol, where India has given a commitment to go carbon neutral, and even European and US standards are clearly giving a priority to ESG norms. Reliance certainly had a tough time finding fundings if he had continued on the oil and gas sector. They had clearly diversified, given that ESG is a priority for the industry from the finance point of view. From the point of view, they had a diversification strategy. Similar case studies with the Tatas. So Tata really struggled with the debts, the structuring of the companies, and even innovation front. I clearly remember where people had an opinion that Tata cars are not doing great. Now Tata has entered into the electric vehicle. They are doing really wonderful in last 3 years. Even the debt structuring had been done. They have hid off their non-core companies and restructured their companies, and where they have sold off certain companies and reduced their debts. So Tata has re-emerged in last 3-4 years compared to a decade ago. Similarly, L&T had their own share of de-risking from infrastructure portfolio. Infrastructure really had a tough time from 2000 to 2010, and L&T de-risked themselves by entering into ITGS, IT-enabled service and technology sector. Now, if you see the market valuation from the infra business and the IT business compared to Mindshare, Mindtree, L&T Information Technology, LTTS and LTI, they almost are as equivalent to the business to the infrastructure business of L&T. Similar diversification is being done by NTPC and big oil marketing companies to diversify the risk. So we can clearly relate how companies go about from the enterprise risk management point of view and manage their strategic risk, and as well as key operational risk, which really has an impact on the businesses. So these are some of the risks an infra company have identified. This has been documented based on the public document, whereas you can see an infra company have listed right now technology is one of the emerging risks, which L&T has clearly marked out in the financial statements. and they are working on an L&T Next, which is another to mitigate the risk. Technology from safety point of view, drone point of view, way in which they are doing construction, and this with international bidding happening in infrastructure segment. Clearly, companies need to build a strategy around it. If they are able to identify the risk, then they will be able to build a strategy around it. If tomorrow, if you don't prioritize your cybersecurity risk, your fund allocation, your policy decisions, everything will be on a low priority. We have seen a major company like a cement and maybe mineral and metal company had a cyber attack a few years ago, and that threatened the entire group. And they are almost they are Nifty 50 companies. So you can see, then they shifted the cyber security from a low priority to high priority. And this happened during COVID times, which had a significant impact on their operations. So again, you have to have a clear leverage, and you have to ensure that your ERM framework is mature and it is not a one-time activity. So this is an layout, how an ERM risk management structure works in an organization. So ideally, there are in the 4 layers where the top are coming from the bottom. Generally, people at the bottom have to identify function owners and risk owners along with the risk champions, identify the risk relevant to the functions and map it, and then they create a repository of that functions. And so the risk champions have to work along with the risk owners to update the risk register for department risk registers. For example, HR department will have a attrition as a high risk, or whistleblowing as a high risk, or tomorrow payroll, incorrect payroll processing as a risk. Finance will have a forex as a high risk item, how the companies are managing it. Marketing will have a social media management as a high risk item. Legal will have a contract management or upcoming litigations from the employees or whistleblowers may be high risk items. And so accordingly, each department has to do their own exercise and identify which are the high risk items, and then they map it in the risk registers, which are largely updated by the champions who work under them. And then once they evaluate it, then it is the high risk items, or based on their risk management policies. These are largely discussed by risk management committees, which now is more of a statutory body. Statutory is more of a statutorily required committee under the Companies Act. So now this is clearly required even by the SEBI, and which in turn is reporting to the board, and even audit committee keeps a note of it. So a company will need to have an ERM policy. ERM policy should be a charter and clearly describing the procedures, role, responsibilities of at every level, what process needs to be followed, how it needs to be evaluated. That clearly gives an overview how the things need to be documented and followed religiously in spirit. So that is one of the key things which is required from the board. So for example, a charter, it clearly demarcates what is the role of board risk committee, who are the members, what is the frequency they need to meet, what are the in what shape and form the reports will be, risk registers will be maintained, what is the framework in which risk impact assessment will happen, what is the company's appetite for the risk. So these are the general things which are documented in the policy, and it clearly also tells the review mechanism and everything. So elements need to be well mapped in the policy for the sake of standardization. For example, in a TCS, where there are 3 to 4 lakh employees, and I understand every level may not be involved in the risk management activity, but if there are 10,000 key middle level management and top level management are doing this exercise, it needs to be so robust. So because there are project related risk, there are cyber security related risk, IT related risk. So that documentation and evaluation is very important to ensure the right risk are not just it's a top management who is involved in identifying some risk. It is the middle management that will really throw up the will give the more data points and key risk to the top management. So it should be top-driven approach as well as bottom-driven approach while identifying and evaluating the risks. So we have seen, so many organizations does start this journey of risk management. They start once, they are enthusiastic for the compliance with purpose, they start it, but then suddenly stop. Many companies does start it, but then they end up finding the same risks. They don't apply themselves and they get very standardized. So some companies start off well, then suddenly they stop it. Then there's some event, some push from the independent directors, they restart it. So it is very vague. Only the mature companies are able to consistently maintain the ERM framework and then ensure that it is not a one-time activity, but an ongoing process where every quarter risk owners have to give their high risk, their risk register, chief risk officer have to be involved in activity. External risks are also seen, and then the key data points, the key exceptions are go to the risk management committee for their evaluation, and then it goes to the board of director. So that is the journey any risk management of we have seen in any company how it works. Now to summarize the thing, we have said a lot on the risk management framework, but as a risk management process, I'll further like to elaborate the same so people at a larger context understand how the company identifies risk, to assess it, and then respond to it, and then report to it. So I'll just go through the entire journey of the risk management journey. That really helps us to understand that. So ideally, risk, we know risk clearly is to move from the present state to the business objectives. If tomorrow you are a startup, you want to achieve something like Paytm had to start, had a current state during, had to achieve, be top leader in the market and had to multiply their GMV or the customer acquisition by 10 times. But then we had seen certain events, competitor like BharatPay and a lot of companies have entered into the market and they are not able to achieve it. So their strategy again, so the risks are going to be there. You have to keep on identifying the risks. So for risk, again, the risk identification, you have to build a profile. Whenever you identify risk, whether it is strategic risk, whether it's an operational risk. So strategic risk is something in which ideally decision making revolves around the top management. Okay. For example, tomorrow, if you have to diversify into certain companies, like LAT needed to diversify into technology side, that is a strategic risk. Operational risk are health and safety, production, these are related to the operational risks. But nonetheless, each one can be a high priority for the management. Compliance risk, for example, a Facebook has this as a compliance risk, it is also a strategic risk for the company. So compliance, they have to comply to the lot of countries' compliance requirements. Financial reporting, generally reporting risk is not just from the financial reporting point of view, but the normal ESG compliance reporting and everything. So is there any material misstatements and everything? So again, coming to these are type of risk category, but then what are the sources of risk? Sources of risk are generally internal and external. So external, for example, internal risk is when like these sources of risk are really important when you are tracking the risk and identifying the emerging risk. I'll give you one example that will be more happy to describe in front from example point of view. When, for example, Reliance moved from oil and gas to media, there was suddenly change of strategy. So when they are going to media or telecom, Reliance Jio will have a different set of risk when compared to the oil and gas or petrochemical business. So that will have the risk itself. Again, organization structure. Organization structure or structure of your how your companies are being mapped. For example, tomorrow there is a demerger of geos, then it will have its own set of risk there. Or tomorrow in your organization, finance and treasury are not separate, or internal or your finance function are not separate. It has a structural risk to it. There's a conflict of interest in rules. So that we have to keep aside. Then process risk. we generally find out during audits, but then we see that many of the risks which are identified in the audits are not communicated in the taken care in the risk register by the process owners. People risk. So again, people risk we have seen there are errors being made by the people out there or something, or there's a certain class people awareness issues within the company about the systems or processes. Trainings are not done. Then culture again, culture is very important. How you take this risk management activity, or what is the culture? For example, Israel has a very different culture than India. India being a society of very risk conservative, whereas Israel is very risk active, proactive. So where is your domain? And sometimes top management will have a different perception of the different way to handle the things, and they have a different risk culture. While a middle management will be more reserved and in their approach, more conservative in their approach. That clearly demarcates what is the risk culture of the company. Now, technology is nonetheless, we all know how technology is influencing it. So cyber, again, with the way in which we are doing, cyber is a key emerging risk. So from external point of view, inflation it clearly has an impact. From cost pressures, as it clearly put the cost pressures on us. For example, coal price have multiplied 4 times. So it is a clear threat to the cement steel manufacturing company. Social, political thing, we can clearly relate Ukraine issues and political. These are something, again, social issues are something we have to keep in mind. What are the social norms of the industry? So there are various ways and means through which risk are emits, and we have to keep a track of it. Now, coming to risk identification technique, there are many of them. These are illustrative lists. It can be a brainstorming session. In a top-down approach, clearly senior management or CXOs come into the meeting room and identify, brainstorm and list down the risks. Or it can be more of a workshop session where middle management and senior management is getting involved. If you interview, you have an open session, and then you list down the risk. Every participant is allowed to give their viewpoints. Or you can have a documented repository, like risk registers, everything you have, and even lessons learned from the previous projects or previous events like COVID. Post-COVID, every contract clearly mentions pandemic for the pandemic in their clauses. So these are again, there are data analytics where risk-oriented data analytics. For example, your concentration, your collections, how much percentage dependency on one supplier or dependency on one customer, or your outstanding is more than your threshold limit from one particular customer. So these are various ways and means through which we identify the risks. Now, these are the illustrative cases where we have classified risks for a road company. Technology, we have discussed a lot on this side. Maybe given we can have a look at it, and then we can skip it, move to the next slide. I'll read some of them. For the construction company, technology is evolving, so that is a clear strategic risk. Operational risk is like a design errors or poor constructions is a risk. Regulatory risk is another thing. Environmental norms is something which clearly road construction company struggles with. And contract risk, a lot of work is outsourced in a road industry. So then how they are able to pass over the risk is also important. What the risk they are in the business in, and how they can translate it to the subcontractors. Financial risk is like financial closures, and financing is very important when we get a new projects. And then IT risk is loss, data protection, and cyber attacks. Now, every risk needs to have a risk appetite. Okay, if you want to grow large, then you have to have a larger appetite. Your appetite for bad debt should be high, or something like, for example, Bajaj Finance will have a higher appetite for NPAs compared to banks, okay, because their risk they want to grow at a faster pace. Similarly, so every risk first needs to have a risk appetite, else it's difficult. And that management policy and top management should decide how much. For compliance or cybersecurity company may have a low appetite, so they will invest more resources. Even a single event will trigger alarms in the system. It's something like bad debts, or tomorrow you have an export, you are willing to take a risk on the forex side. So company needs to define a risk appetite before even assessing them. So it depends. It doesn't mean that every risk has to be mitigated. It has to be, you have to define your appetite for the same. Now, when you are evaluating the risk, doing a risk assessment, there are various ways and means of doing the risk assessment. On that side, starting from the impact assessment, so how you do it. For example, cyber security, you analyze. First, you measure the importance of the risk. You have to quantify the risk. That is of the most importance. To quantify the risk, there are ways and means of doing it. So ideally, people do the impact assessment. A cyber assessment threat may, if you don't have a BCP plan, then it's going to be high impact and likelihood. You have to identify whether it based on the past history or likelihood of happening it. There are frameworks around it, where if, for example, earthquake is a very unlikely possibility in Mumbai when you compare it to the Kashmir or Indonesia. So there are frameworks you define to rate them or scale them, and identify accordingly. You evaluate the risk exposures to it. I'll give you certain example. For example, this is a risk assessment of an ITGS company. Information security is a top priority for them. You can clearly read it. That is the highest severity. Talent, again, they are struggling with it. Changing technology every day. There's some other language, Python. Then there was C++, Python. Then there is the new skill sets of people you're requiring. There's again some open softwares, and there are upgradations which are required for their, which really impacts their platforms. Revenue concentration, we clearly noted that Citibank is one of the larger customers, or it may be some other bank which a company may be totally dependent on. So there are the risks. So you have to scale out your impact. These risks, what are the impact of the risk and what is the likelihood of the risk. So this is a typical framework for financial risk. If its impact is going to be more than 2%, I'll rate them high. If its impact is between 0.5% to 2%, I'll rate them medium. So if it's going to threaten my existence, I'll rate them high. Business continuity planning. If it's going to just hamper me for 10 days or 5 days, it's okay. For a cement or a steel plant, temporary closure is okay. And for 2 hours, 3 hours, and they rate it as a low risk. So you have to clearly describe your risk assessment while doing a risk assessment activity. So these has to be well documented in the policy as a guiding principle for the people who are evaluating it. It can be a top management, it can be a middle management, because these, for whether it's an operational risk or a strategic risk or compliance risk, it has to, when you are doing a risk assessment, it has to be evaluated accordingly. So I'll just skip the slide. This is similar thing, likelihood event. If it's going to happen once in 10 years, you can say unlikely, like earthquake, or pandemic is unlikely event, or tomorrow. So accordingly, you have to scale and do a rating. So again, there are approaches. So of doing this risk assessment, generally company prepares the risk inventory. Okay, risk inventory where they will have 100 of risk there. Once the risk inventory is there, then company finalizes, or it may be coming from the functional risk registers as well. It may be, I'm just giving some illustrative examples, but they have a functional risk registers or the entity level registers of the risk which they maintain. And then they have to identify based on evaluation and the rating done. They identify the top risk, and then these top 20 risks are further through surveys and polls identify the top 7 risks. So these are the way in which, and see, because every risk cannot be mitigated you have to identify top 7 risks which management needs to be focused on. For identifying top risk, there is a way in which a company follows certain processes, or there may be a different way. I did a review for oil and gas company that a clearly way that they had more data points to identify financial risk. Okay, so they had more data points, so they evaluated the probability. For example, in this case, loss of market share due to expiry of their licenses, geographic licenses and infrastructure. This is a gas distribution company. So they had done this exercise in which they feel that they are going to lose a market share if their licenses keep on expiring, and it may not get renewed. So next risk, they also worried that tomorrow CNG vehicles are going to be replaced by electric vehicles and everything, and what is the growth and how they went about it. That is more of a working they have done. What is the growth of the CNG vehicles? What pace it is going to run? How much is going to get replaced by electric vehicles? So they have various ways and means to identify the likelihood and impact. That it depends. It differs from one company to another. Finally, they have this risk map where top risk is largely a domain of the senior management gets involved. Middle and low, it depends. Low risk, generally it is risk owners and CXOs who manage them. And accordingly, see these are the key decision points through which funds are allocated in the annual meeting, in the annual budgets. So every risk cannot be mitigated. If it's within the acceptable level, if your bad debts are within acceptable level, if your forex, if you are exporting company and your currency devaluation in India, generally currency doesn't appreciate. So you think that okay, 1 or 2% appreciation is not going to matter, and I won't hedge if the volatility is within certain range. So suddenly, or you find that risk mitigation is going to be a bigger affair. Then you clear, for example, tomorrow you have a threat or locational threat, but that there can be an earthquake or there can be any government norms around that, but you cannot shift your factories. So you believe you should continue and pay the penalty rather than shifting a factory is going to be a difficult activity. Monitor them. You set your KPI thresholds. Some like forex, I give an example. If volatility is within 5%, then we are okay with it. You transfer the risk, like insurance, you buy insurance, or you share with the third party. You enter into joint venture sort of thing. Next is mitigations. Certain risks you can mitigate, like for earthquakes, you can make earthquake preventive buildings, or you can have a contract with a party where you don't take this risk going forward. Or there can be mitigation contingent action to reduce the impact. So you have a BCP plan. Whenever there is something, you have a reaction time and you can stop the impact. Discontinue the business if you're not doing great. For example, you have a transportation business, you're not doing great, discontinue them. So ideally, risk recording is generally every department has a risk recording done. Risk recording which they do it. Every risk owner have to map the risk. Again, what is the likelihood based on the framework? They have to do likelihood. There's lack of talent and high attrition. What are the reasons? Job attrition, low compensation, career advancement. There's HR is responsible, but in every department, likelihood, impact, velocity. Generally, many companies have this parameter as well. How fast is going to impact? So tomorrow, post-COVID, there was high attrition happening. So it was high velocity. The employees are going to leave in a month, or employees are going to leave after 12 months. And accordingly, you have your mitigating action plan mapped to it. So top risk is dealt by the senior management, and middle risk are generally by the management committee. So this is a reporting framework. So risks are reported at different levels. Not every risk is reported to the management, and some risks are being monitored in operational meetings, review meetings. But important thing is the framework should be robust, that key risks are escalated to the right persons, and the different stakeholders are like investors, So in annual report, you mention a separate section of risk and investors are informed. Or your risk board, independent directors are informed. So this is important. So again, coming to the next stage. So this is illustrative way in which key risks are reported to the board. This is an example of a fiber optic manufacturing company. For them, impact of technology and demand assessment was pretty difficult, and so they had mapped it. They have made it. There's scoring done. This has been reported. These are strategic risks. Every risk, it is not that high level risk. They have further bifurcated the risk into various layers, like what is the challenge in anticipating demand, what are the technology challenges tomorrow, whether optical fiber are going to be replaced through wireless technologies or satellites. Like we have an example, internet is going through fiber optic cables, but now with the Starlink, it can be directly through radioactive radio waves. It can be received by the users. You don't require a fiber optic in the remote areas. So that will impact the demand curve of the fiber optic cables. So these are the various elements through which it is done, and these are drilled, and these are discussed in the risk management committee meetings, boards. So they have the risk card is prepared. So what are the risks? They map it. What are the root causes? They map it. What are the data points to validate the impact and assessment? And then they define a mitigating plan. And what are the tangible deliverables they have to monitor? So these are the overall framework in which it is worked. So again, these are the actions which are agreed in the board meeting, and they have to be monitored against your appetite. What is your appetite? For example, attrition, if it's within 10% overall threshold is 12% for different segments. If it's within the limit, you keep on monitoring them. And wherever there's an escalation required or management intervention is required, you have to inform them. So these are again the KPIs which generally is inbuilt in the employees thing profile as well. So that tomorrow every risk owner is aware their responsibility has inbuilt risk management in their risk KPI, in their job profile, and in their KPIs. So to manage the risks. So these are various ways and means in which these things are done. So I'll complete my presentation here itself. Any other questions, I'll be happy to answer each of them. Thank you for having patience to hear me out.
Thank you, sir, for such an informative session. We all live in the world of uncertainties, well experienced through last pandemic. Thank you for making us aware the key areas significant in enterprise risk management, which is definitely the hour of need for every organization now.
Yeah.
Moving on.
Thanks.
Thank you, sir. Thank you. Moving on to the question and answer round. So we have questions from participants. I would request CA Yukti Arora ma'am to please address the questions related to the topic. Yes.
Yes, sure.
Yeah. So one of the participants has asked, what is patching? How can we ensure cybersecurity patching? Even in an organization, SAP is implemented, then there are 5 to 6 schedule, and every schedule in charge knows only about his area. How his area is connected to known to him. SAP in charge does not know accounting. We suggest companies should use only those softwares which are permitted by ICAI. Your comments on this?
So, Shripriya, I couldn't hear the complete question, but what I understood was I think the question is around patching, on what is patching and how it has to be done. So, patching actually is all these software providers, SAP, Oracle, and each of the software provider, they provide the patch to fixing some codes, bugs, fixing some new security threats, bringing out new functionality, So patching enables the organization to update the application, to update the infrastructure, so that they are not exposed to the vulnerabilities which are there in the current new scenario. So, or the upcoming scenario. So, from that perspective, patching enables the organization to address the vulnerabilities which exist. There was second part of question also, Shivpriya, if you can repeat.
The second part is how can we ensure cybersecurity patching? If in an organization SAP is implemented, then there are 5 to 6 schedules, and every schedule in charge knows only about his area. How his area is connected to other one not known to him. SAP in charge does not know accounting. So basically, the question poser is trying to tell that the companies, he's trying to suggest that the companies should use only those softwares which are permitted by ICA, but that's practically not happening.
Absolutely, like some of the challenges are here. There are certain challenges where because of the lack of awareness, lack of training, lack of coordination, operations in silos, certain people do not know the complete organization functionality from a SAP or ERP, whatever it is implemented. I think the training and awareness, interaction between the stakeholders resolve this thing. There is no cyber security patching. There is only like the patches which are there. They need to be looked and they need to be applied on the time.
Right. Thank you very well. The next question.
Basis. And to improve this, the organization should interact more between each other department. Yes.
Okay. Thank you, ma'am. The next question participant is asking that we are using AnyDesk as one of the tools. Is it safe or any other safe option could be suggested here?
See, AnyDesk is a tool which helps you to provide online support, exchange data also, and you can download, upload. See, it is actually not very safe because you can access and you can actually get the access to the other application or other system through this tool. But it helps, it has an operational efficiency, it brings certain things. So there need to be certain processes also along with the application implementation. The organization should disallow the exchange of copying, pasting, encrypting. There should be monitoring of the exchange, and the logs needs to be generated. They need to be any copying should be disabled. Encryption should be enabled. The connection should be through VPN so that the exchange of data is encrypted. So those types of mechanisms can enable even safe exchange of data through AnyDesk type of tool. And there are multiple safe options which are available. The collaboration tools, there are multiple collaboration tools which are available. Even the Microsoft Teams and all these large cloud service providers, they have the collaboration tools. That any one of them can be evaluated and then they can be deployed, but obviously DLP needs to be implemented on the top of it.
Thank you so much, ma'am. I'm sure the participant must have been fully satisfied. The next question is for T. Shankara sir. Shankara sir.
Yeah.
Sir, the participant is asking, in most of the companies, scrap is being sold as per management decision to the management party itself, and sometimes entry of outgoing is also not done. What should be done in such scenario?
Can you repeat the question once more? I'll just answer. Yeah.
In most of the companies, scrap is being sold as per management decision to the management party itself, and sometimes entry of outgoing is also not done. What should be done in such scenario?
See, here, who is the management? See, that's I told the plant head was a management. To be very honest, the management is the company is controlled by the board of directors and chairman. If the management says, means the vice president or the president, if they do this kind of activity, we have to report. Like I have reported cases where the vice president and the president a project had done it, to the board even, or to the chairman. So here you are saying that the management does not mean it can be a president, it can be a vice president, it can be general manager also. Whether the board is giving directive, no. And what happened today, if you don't report, what will happen is tomorrow, when a massive fraud takes place, then they will blame the internal auditor only. At least he has to put in record to the chairman, this is what's happening. Then if chairman don't take action, he can always say that I have put in record. That's what I suggest, based on my experience. I have put in black and white number of times, even a major fraud, everything. After management don't take action, I don't bother, but I have put in black and white.
That's very nice, sir. That's what an auditor's duty is, actually. Thank you, sir. Thank you so much. So with this, on behalf of all the participants, I thank all the leaders of the industry present in the session, esteemed guest speakers, for taking out time from their busy schedule to make this session a huge success. Please accept our sincere appreciations for the outstanding presentations you have given. I thank the Internal Audit Standard Board of ICAI for this initiation. Such seminars are indispensable in continuous learning and practice for complete chartered accountant fraternity. Lastly, I thank all our participants who have been such a great audience and patient listeners. Friends, here I am being reminded of an interesting quote inspired by Sri Bhagavad Gita that teaches us the importance of balance in life. They say, केवल कर्म, केवल ज्ञान, केवल भक्ति का कोई मोल नहीं. केवल कर्म, केवल ज्ञान, केवल भक्ति का कोई मोल नहीं. कर्मी के हाथ, ज्ञानी के चक्षु और भक्त का हृदय, इन तीनों के समन्वय से जीवन सार्थक है. So I wish you all a very best in life. Stay motivated, stay positive, and take good care of yourself and family. Thank you, everyone.
Thank you.
Thank you.